everybody, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and what a pleasure it is to join with you each and every Tuesday to share our insights about the financial and economic markets, as well as provide some education on topics that, well, every now and then we hope you find terrifically interesting. This program is brought to you by the Society to Advance Financial Education, and I am so pleased personally as well to have you here. So thank you so much for joining us, whether you're through our meetup groups live or you join us live on the Ustream feeds that go around the world. We're glad you spend this time with us, so thanks very much. Now, last week, as you recall, we talked about college education, and we talked about the necessity of it, how the world has so greatly changed in the last 30 years. But we shared thoughts on the fact that you won't pay sticker price for that college education, so don't panic when you see the initial $50,000 bill. The reality is, between grants and loans and other things you can do, you can whittle those bills down a great deal. In addition, we talked about some of the good and the bad and even the ugly of the college loans. We focused sometimes specifically on the fact that when you take those government guaranteed loans, you can't go bankrupt on them, so you better plan on paying them back. This is highly important in a country at a time where college education is becoming the default standard for employees, not as it was so many years ago when it was high school. So we hope that program was helpful, and we welcome you to write us at questions@safefinancial.org when you have specific things that come to hit you. In fact, leading us into this week's question was a directed question from last week's program, and this is perhaps the most real of real-world problems. A person wrote to us and said this: "My wife and I didn't plan ahead when our kids were entering college early enough, so now we find our son going into college and a great big bill headed our way, but we have no 529 plan. We have no savings for this. How do we handle it?" Well, I referred them back to our video from last week, and we talked about how, first of all, apply for all the grants and loans that you can possibly do. And don't ignore the scholarships, both offered by the college or by the state or by any other organization that can whittle away at that college bill so it doesn't hurt you quite so bad. We further talked about the way to cut college costs, considering, for example, in the early years, first and second year, considering community college or even online college. And we talked about the cost savings that can accrue when a student tests out of classes. You know, my kids going through high school had the opportunity to take advanced placement exams. Well, when they got those done with a certain percentage, it actually gave them college credit, so they didn't have to pay for that pricey credit from the university. So we talked about some real ways to reduce that problem, and then talked about how he could finance it over time. So I think we were able to accomplish his needs, and we're very, very pleased that he had written us in the first place. So we welcome you, as always, to write us at questions@safefinancial.org. Hopefully you've had a little better luck planning, but if you haven't, let the society be there to help you out. After all, the society was built for you. Now, in the geopolitical world last week, there's a lot going on. In fact, you and I could talk all day about it. I was interviewed on Newsmax TV this afternoon, and in fact last week as well, talking about the massive changes taking place in our world right now. And I want to highlight 3 of them, although I could probably talk 4 or 5 real easily. The number one thing hitting the list certainly last week was North Korea's invasion of the U.S. technology space with its hacking into Sony computers. Now, you could look at this and say, what's the big deal? An elite entertainment company gets its computers hacked into, and some of these entertainment elites have their private thoughts released in their emails. Well, an awful lot of embarrassment went out about that, but there's a more serious issue here, of course, and that is that the North Korean government has now been proved to be implicated in hacking into this system, and that's a broader issue. In fact, it's been thought of as the Pearl Harbor of the cyber wars. We've not had other nations so blatantly do this before, and North Korea did it in response to a film they considered offensive. Well, that's a bad blackmail situation, and we as a nation need to have some strategy developed from our national security organizations to deal with this kind of invasion and stop it right now. We don't want to have this sit idly while other nations say, maybe that's a way we can attack the United States. So this little hit on Sony Pictures is a sign of something bigger. We'll have to watch North Korea and see how they react to our response, whatever that might be. We know that in the last day or two they've come out and threatened the White House. Now that's not unusual for this little dictatorship. Kim Jong-un has a big mouth, as did his father and grandfather, and he's pretty quick to threaten things when he doesn't get his own way. So we don't expect any significant consequence, but the cyber war part of this is real. The average cost, by the way, to the American economy, if you break it down to the average business expense, a normal business spends about $57,000 a year on cybersecurity. Well, think about that. When you get to the size of Sony Corporation or IBM or GM, they have the resources to spend the tens of millions of dollars to keep their system secure. But what about your local grocery store? What about the local retailer, the haberdasher, the cobbler, the people who built this country? Well, they don't have that money sitting around, so for them, it's a very real cost. And that's why it's an important issue that we're going to have to track going through time. Now, the second thing to hit the radar last week continues in this discussion about Vladimir Putin and Russia. In a speech last week, Mr. Putin came out and said we were reigniting the Cold War. Their movement into the Ukraine, which caused a backlash from the NATO countries, has put different economic consequences on this Russian Republic, and those are starting to hurt. As we now have oil that's come from 110 a barrel down to 56, the Russians are hurting for money. And that's causing Mr. Putin to lash out more nationalistically and try to continue to get support from his nation. Well, we want to watch what Mr. Putin does here. We certainly don't want to give him a misread that the United States won't react if he attacks one of our NATO partners. We want to be crystal clear that there's a response to that so he doesn't miscalculate. The third thing that's important that I thought that you should know about, related almost to the Russian situation, is for the first time China released MIRV technology. Now, if you're not familiar with that nuclear warfare term, MIRV stands for Multiple Independently Targeted Reentry Vehicles. Basically, what it means is one missile can carry 10, 12, 14 bombs. Now, the United States and Russia have had this technology for decades, but the Chinese just got it. It was actually acquired back in the 1990s when they stole some United States secrets. Well, the Chinese, now having this technology, have ramped up their nuclear capability, and as they become part of the global geopolitical structure, they've come into a new level here. So we want to make sure that we're monitoring our relationships with China and Russia equally, realizing that they're not our friends, they are our trading partners. And we need to treat them like that and make sure that policies put in place in the United States don't change that balance of power to their favor. Now, obviously, there are other things going on in the geopolitical world. We still have the economic slowdown in Japan. We have the economic disaster going on in Europe right now. Their economy's slowing down. Without the wherewithal to stimulate it, we're not sure where that's going to go. Those affect you, and I know many people say, well, what do I care what's going on in Europe? Well, the fact of the matter is we live in a global economy, and that global economy affects your lifestyle through your investments, through company profits, employment. It trickles down through the entire thing. So these geopolitical events are extremely important, and that's why we bring them to you each and every week on the Master of Money. Now, in the economic world, I think the most interesting news last week was seeing some dissension in the ranks at the Fed. Janet Yellen's Federal Reserve has continued with the zero interest rate policy up until now, but recently has come out and said they could see an environment in which they raise interest rates in 2015. Well, that caused a backlash from the Minneapolis Fed, who's concerned that we're really not out of this yet. We don't see core inflation. In fact, inflation's been at the lowest point it's been for many, many years. We see gas prices coming down, which is deflating prices around the economy. We see an economy that is, yes, it's growing, but it's very fragile, and we all know it. So the Minneapolis Fed came out vocally against raising interest rates and worrying about how we are building this bubble, but we can't kill the economy through a massive interest rate hike. Well, we continue to watch the Fed, and as my good friend Doug Roberts wrote in his book, Follow the Fed, we know that it has a material impact on the markets and on people's investments. So we want to make sure we follow the Fed. Now, in addition to that, I thought it was interesting looking at the Fed's comments, because one of the things we noticed last week is that industrial production in the Midwest, as well as the service sectors in the Midwest, began to slow down in October. Now, this isn't good news. As you and I have talked, we saw very good growth in the second quarter, good growth in the third, and we still expect good growth in the fourth, driven by low oil prices. But to see industrial production slowing down and to see the service sector slowing down unexpectedly in October is not necessarily good news. We want to keep an eye on that, because while inflation is down, economics seem to be working pretty well right now. The growth rates are up. Again, we are all invested for the future, and we're looking at what might happen if these numbers change. So on those economic events, we want to keep an eye on those for you as well. And in the financial markets, the major market indexes rebounded nicely, and they've actually gone up to new record levels. Last week, both the S&P and the Dow were up over 2.5%. Very nice gains. And that friend of ours, the VIX, that we talk so frequently about, coming off of its massive gain the week before, actually went downward and dropped by about 5.5%, indicating that volatility came down as well. Well, we know these markets respond to economic news, and they respond to the financial news out of our corporate earnings and corporate picture. Companies continue to do well. There is a lot of cash sitting in corporate America, and if those companies choose to release that cash and start using it, we could see this economic environment grow substantially in 2015. We remain cautiously optimistic. Now tonight, I'm going to talk with you in the second half of the program about something that affects millions of Americans. And I'm reminded by a friend of mine who watches this program, who said the only problem he sees with The Master of Money is that millions of people don't watch it. And if ever there was a show I wish millions of people would see, tonight's is going to be it. We're going to be talking about 401k plans, an often discussed, thoroughly understood program that to some people just isn't thoroughly understood. We have a real disconnect between the institutional world of 401k's and the individual participants in 401k's. And we're going to talk about that tonight. I'm going to give you a little bit of a history lesson on it, because it's relevant to understand where we've come from to know where we're going. But we're going to talk about the individual participants and how they need to start working to prosper and set themselves up for success. But we also want to address a special message to the plan sponsors. If you're watching tonight, or you know someone who should be watching, and they happen to own a business or they operate in a senior level at a company, there are new, what I would call, liability traps that have evolved for 401k plan sponsors. And we want to talk about those with you, because this new environment of liability for the 401k plan sponsor can be easily mitigated. But if they don't know they have the problem, well, then it will sustain. And again, I'm reminded of a very wise man who said to me once, "I'm not afraid of what I don't know, but I'm terrified of not knowing what I don't know." Well, unfortunately for many business people, the 401k world has become a situation where they don't know what they don't know. So we're going to talk about that when we come back tonight. So as always, we hope you'll sit back and relax during the short break. And when we come back, we are going to continue our path to prosperity, talking about 401k programs. As always, we're going to hit the good, the bad, and the ugly. We'll be right back.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back. The good old days. Some of you may remember these when we came out of school and we went to work for a company. For 20, 30, 40 years, we worked for that company. And then when we retired, we took advantage of our defined benefit plan and were able to retire on earnings that had been saved by both the company and us. Pretty nice thing for most people. But that's changed a great deal, of course. We had the 1970s come about and a new law called ERISA. Some of us in the business have considered that every ridiculous idea since Adam. But with ERISA came the development of individual retirement accounts and other things, most specifically the 401k plan, converting out of a defined benefit into what's called a defined contribution plan. Now, initially, this seemed to work really well because the companies were having real problems keeping up on those defined benefit plans. And this creation of the 401k shifted the responsibility from the company to the individual. It seemed good on paper, but the problem was multiple-fold. What we found as we got these going is that the individual participants had neither the education and in some cases the interest in managing their own portfolios. So the 401k plan became kind of a problematic circumstance. You have a situation where companies were contributing money, individuals were contributing money, so the money was put in, but the returns on the money were specifically the responsibility of the individual. And without being professional money managers, well, that created a gap. The gap was filled by the investment management industry in whole, whether it was a mutual fund company, an insurance company, a broker-dealer, or an investment advisor. Professionals stepped in to help companies and participants alike manage those funds. Now, what we saw out of that was some really terrific success. If you go back through the 80s and 90s, we saw a booming stock market. In fact, I saw some numbers I wanted to share with you. I think the market's up 17-fold since 1980. Not a bad return. The bond market did remarkably well. Those of you who are old enough remember the early 80s when interest rates on bonds were at 14 and 15%. Well, the fact is those interest rates have come down to zero, and as they've dropped, bond prices have surged. So in the 80s and 90s, we had terrific performance in the 401ks, making everybody feel pretty optimistic about them. Seemed to be working. We were introduced to things like the efficient market hypothesis. Some of you may have had advisors tell you about that, or the efficient frontier, which maximized risk and return trade-offs. We were soothed by an industry who knew big words like standard deviation, alpha, beta, and gamma. I mean, we got so seduced in that period. I remember talking to people, and when I said to them, "What do you do with your money?" They said to me, "I invest in mutual funds. They always go up." Well, the 2000s changed that mindset. Now, through this time, there's another thing I want to remind you we were introduced to, and that's called target date funds. Many of you have been invested in these, and basically what they did, the investment industry responded to the needs of the 401k world and said, we're going to give you a predefined set of funds. The asset allocation on these funds will be contingent on your age. So if you're young, we'll be heavily geared to the stock market. As you get older, we'll migrate your funds to the bond market. The idea being when you hit 65, you're mostly in bonds, which traditionally should be pretty conservative. Sounded like a good idea? And again, with the stock market and bond market performing so well, everybody was comfortable. Everybody was happy. Well, then came a new century and some new rules. The capital markets, as you all may recall, in 2008, what's the word or the phrase? It laid an egg. Indeed, by 2009, the market had sunk 50% off its highs, down to a low of about 6,500. And the word out of Washington was nothing but terrifying. Well, what happened, of course, is that the retail investor, that person responsible for their own 401k, panicked. Millions of them got out right at the bottom. What a tragedy. Since 2009's low of 6,500, the Dow has jumped way up to over 17,000, achieving new record highs. So yes, many of those people jumped back in and were able to capture some of that gain, but it created a sensation of fear in the plan participants that oftentimes led to suboptimal investment programs. Now, many people have still, through this period, been looking at their target date funds as a solution for their specific retirement needs. Well, let's look at some interesting facts there. The market has continued to do well, a major cause of which is the fact that interest rates remain at zero. Indeed, as I mentioned earlier in the economic section, we have dissension in the ranks at the Fed. Some components want to raise interest rates so that we don't build this debt bubble that could pop. Others are saying the economy's still weak enough, we need to stimulate it with further zero interest rates. Regardless, what's happened is, as people have come into their target date funds and they've been moving from stocks to bonds very cautiously, it's all worked out well up till now. But there's a bomb on the horizon, and you need to know about it. I want you to remember with me a lesson that we've taught for the Masters of Money, and that is simply this. What happens to bond prices when interest rates go up? That's right, they go down. There's an inverse relationship of bonds and interest rates, so that when bond prices go up, it's because interest rates are down. When interest rates are up, bond prices go down. Think about a circumstance in which a person achieves that magical age of 65. In their beautiful target date fund, they're now fully invested in bonds, and interest rates start to go up. Yeah, it's silence for that, because that person is going to get hurt. Now, they're not going to get hurt because the manager necessarily broke their fiduciary responsibility. They didn't. They offered the target date fund as a legitimate opportunity. The person's not going to be hurt by the employer who says, I'm not a fiduciary here. You made your own investment decisions. The person in that plan is going to be hurt because they made an investment decision without the knowledge of the markets they needed to build a thriving portfolio. So that's part of the problem that we're out to address tonight. Those of you who are participants in your 401k, you need help. In the 80s and 90s, we developed a mindset of set it and forget it. If things generally go up, just put it in there, close your eyes to it, and watch it go up. Well, that's a dead phenomenon now, in our opinion. I think now what's more important than ever is what was referred to as tactical asset management. You need to develop systems and methods through which you can get in and out of sectors, stocks, asset classes, markets even, based on predefined and analyzed criteria. A very disciplined method of doing this can protect you from getting slaughtered if interest rates run up really high. What we're concerned about, of course, is this interest rate bubble. If the Fed raises rates in 15 and the markets react negatively to that, you could see the stock market come down and the bond market. Well, that's not going to play well for those of you as participants in the 401k's, is it? So we would urge you, write the society. We are introducing a program called Safe Certified Advisors. And this is a very select group of advisors that we're looking at, people with whom we would trust our own money. So if you're looking for an advisor in your area, write the society. Again, it's questions@safefinancial.org. And we will send back to you, assuming we have one there. We may not. But if we have a Safe Certified Advisor in your area, we'll get you that name. These are people who have a very special characteristic of their practice. A moment ago, I mentioned to you that you have a plan participant who's looking at the provider, Fidelity, MetLife, whomever that may be, saying, help me, I don't know what to do. And the plan provider is saying, well, that's not our problem. We've given you these investment funds. These are prudently defined. Pick one that you think best fits your goals. They look to their employer and say, help me, I don't know what to do. And the employer says, I'm not an investment advisor. I can't advise you what to do. Well, in response to that, there are two things that you need to know of. First of all, there's a liability here at the plan sponsor level. I mentioned in the earlier part of the program, I wanted to direct these comments to business owners and senior management at companies that sponsor 401k's. If you know someone who does, please let them or get them in touch with the society. What happened is because of that situation in which the plan participant was left in the cold, the Department of Labor changed regulations a couple of years ago and created a circumstance in which liability, fiduciary liability, is now placed on the plan sponsor or the company to help those individuals. Well, yes, that creates a problem because the company's not an investment advisor. Well, evolving out of that legislation were new advisor criteria, one of which is a new fiduciary standard called a 338 fiduciary that allows a very specialized advisor to go in and work with the participants of the program at an individual level. It's highly important because if you're an individual participant, you want a 338 advisor to come in because they can talk to you. If you're a provider of 401k's, you want a 338 advisor to go in to talk to that individual participant alongside you. And if you're a company sponsoring a 401k, you most certainly want a 338 advisor to walk alongside with you. This is critical stuff. The lawsuits are already beginning to fly because when that participant gets stuck in a target date funds and interest rates go up, who do they blame? They're going to come at the company. If you look at recent lawsuits against Lockheed and companies like that, and even Fidelity, the big money manager, those lawsuits happened because participants sued the company as a fiduciary, not looking out for the best interest of them. Well, I can urge the companies that might see this program, give us a call or write us at questions@safefinancial.org. We will get you in touch with a safe certified advisor who has the kind of licensing and practice reputation to accommodate some of that liability for you. And again, if you're a participant in a 401k and you want individual help with your assets, write us at safefinancial.org and we'll put you in touch with a safe certified advisor as well. This is enormously important stuff. These target date funds are everywhere. And the concern, of course, is that when interest rates go up, well, we're going to have a real problem. Now, last week, I want to mention, I guess, before I break into our Superstock program, one of the problems of the Master of Money program, of course, is it's only a half an hour show. I don't have time to go into in-depth strategies with you often. We try to give you the best information we can to guide you down a path. And we, of course, open ourselves up at questions@safefinancial.org. We urge you to write us with that because oftentimes watching one of these programs will lead you to a whole list of questions you have. Well, unless we know you have them, we can't answer them. So we urge you to reach out to us. We'd like to be there for you. Now, in the Superstock program last week, we didn't have one. And this week, coming into a very fun Christmas week, which I, of course, wish all of you a Merry Christmas, but we have an update on the stocks that we've talked to you about in the past. The first idea we came to you with was Ford Motor Company, which opened at 14 and change on the morning after we talked about it, and today is above 15. Again, we talked about the fundamentals of Ford Motor and why it might look attractive to us. We talked about Cisco that opened at 26.5 and has now moved to a 52-week high at over 28.25. Another nice idea for you, but I want to point out something in just a moment. Let me talk about Google finally. That opened at 526 and is now at 532. In each of these cases, what we're trying to do is not give you a hot stock of the week. We're trying to teach you things you can do to evaluate stocks, mutual funds, ETFs, or asset classes on your own. It's good fortune that Super Stock Investor provides us stocks that win, but it's really not about that. It's about looking at the underlying process. And I want to talk to you tonight about a closer look at one of the things we look at. This is an indicator provided by Phil Erlinger Research. Now, Phil was chief market technician for Fidelity. I've known him for many, many years, and his chief marketing officer is Jeff Garbaz, a very close friend of mine and a consummate professional in the research industry. Jeff brought Phil to me recently for purposes of the Master of Money, and one of the things we're looking at is what Phil calls a volume swing indicator. What we're looking at are situations that buyer behavior is changing on a fundamentally strong stock. The volume swing indicator from Phil Erlinger Research gives us that. I don't want to go into the technical details of how it works, but what we want to do is find companies that have a positive volume swing indicator. In all three of those circumstances we've talked about, in addition to having strong fundamental products, good management, good financials, good growth forecasts, all of them were positive on the swing indicator. If you'd like to learn more about the Erlinger Research Swing Indicator, feel free again to write us at questions@safefinancial.org and we'll get more information to you. Jeff is always standing by to help you with that. Again, I do want to restate, though, we're really not out for the specific top or hot stock, so to speak, but it's a method of understanding, and that's what's important, so that you too become a master of money. Well, as we go forward, it is Christmas week, and I hope all of you have a wonderful holiday planned. I know we're busy. We're going to be on the news a few more times, I think, before Christmas even hits, and next week we've got a lot going on with the year end coming down, so the society is staying busy on your behalf. As always, we welcome you to come to our site and join us. Membership is free, so you can sign up right at safefinancial.org, and we welcome you to do that, through which you get access to our award-winning Path to Prosperity library. That's a 23-lesson audio library that teaches you literally soup to nuts about financial literacy. We hope you'll take advantage of that very special offer. I want to thank our sponsors, Harvest Investment Services. Again, they give us two real advantages. They give us this beautiful facility. They also give us research. And if you'd like to get their newsletter, please write me at questions@safefinancial.org. I'll get you a copy of their weekly newsletter. It's really good reading. I urge you to take advantage of that. So we want to thank Harvest for their sponsorship and Superstock. I want to thank Ron Blake for providing the music you hear at the beginning, and Chris Yantz for providing the music at the end. So Merry Christmas to everyone. Have a happy holiday season, and I'll see you next Tuesday night for another edition of the Master of Money.